Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at 3 growth-focused stocks to consider buying for your December portfolio and beyond. But before we get into everything, I want to say to remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so as of mid-afternoon trading on Monday, stocks had slipped, but that did not stop what's been a great month for the market. So Wall Street has pushed stocks, as most of you listening probably know at this point, to new highs after Pfizer's big COVID-19 vaccine announcement. We've also had some positive news from Moderna and others. Prior to that, the market ripped higher after the election, with investors pleased enough with the likelihood of a divided government in Washington. Goldman Sachs and other major players on Wall Street, such as JP Morgan, have become more bullish during the month of November, seeing the market climbing big next year, so 2021 and in 2022 as well, as we're vastly approaching 2021 as we head into December, which is crazy enough to say. And obviously, a lot of this positivity would ride on the back of a vaccine being effectively rolled out. But it's not just the prospect of a vaccine that's helped people feel a little bit more bullish. The earnings picture has continued to be strong for the third quarter, Q4 2021. The U.S. economy also continues to climb back from its virus-based downturn, and this is all happening without the vaccine. So the vaccine would mostly help at this point. Certainly the social distancing hurt industries such as travel and leisure and the broader hospitality space in general. So with this in mind, the overall S&P 500 is up about 11% on November, and it's on pace for its best month since April, when the market was rebounding from its coronavirus lows. Meanwhile, the Dow has jumped above 30,000 for the first time last week. More importantly, it's on pace for its best month since the late 1980s. So a really strong November. We should also note that the vaccine news helped broaden the market's comeback, which up until recently had been driven mostly by tech players, big tech, as well as big retailers like Target and others who have actually benefited from the pandemic. So far, about 460 stocks in the S&P 500 are up for the month of November, which was the largest share of any month since April. So going back to that beginning of that coronavirus comeback, and this is according to a Wall Street Journal report on Monday. For reference, only 212 stocks in the benchmark rose in October, and only 153 climbed in September. So we had 464 climbing in November. That's a massive jump, and it also helps highlight how important those big tech players were at driving up the broader market, as they account for so much of the S&P 500 and the NASDAQ. So all of this does help set up a bullish case for stocks heading into December and beyond. And it's worth constantly repeating that the Fed has said it will keep its core interest rate near zero through at least 2023, which once again helps support equities, helps support the equities market in general as investors chase returns anywhere they can find them. So with that brief market recap and look ahead to December and beyond out of the way, we're going to dive into 3 of these strong stocks that are worth considering as we head into December and beyond. So we're going to start with the Trade Desk, which trades under the ticker TTD, the Trade Desk. TTD is a programmatic ad firm that uses modern solutions to help marketers find their target consumers across an array of channels and platforms. So we're going to take a bit of a broader view of the space in general before we dive a little bit deeper into the Trade Desk. So digital ad spending surpassed traditional media buying in 2019 as more people cut the cord, turned off their radio dials, and continue to disconnect from various forms of legacy entertainment. Advertisers clearly know they can turn to the likes of Google and Facebook to reach those massive audiences. And Amazon has meanwhile grown to a solid third player in the space. Yet the digital ad market is worth over $150 billion a year in the US alone, and it's projected to reach $225 billion by 2024. And clearly, Google and Facebook and Amazon are not accounting for all of that. And further government scrutiny is coming on Google and Facebook, which could help some of these other digital ad players in the near future. But we don't know what's going on that term just yet. As I mentioned, there's clearly a lot of money to be made in this digital advertising space, and it's just trending in that direction where most ads are going to be in some digital form or another. So the Trade Desk enables its clients to reach these consumers on the giant and vital platforms like Google. But that's just the start. The Trade Desk is an advertising firm that's really built for the broader digital age. It's focused on, as we mentioned, that algorithmic real-time bidding to hit target consumers and not just pay for, say, a full day banner ad on XYZ website like you'll see on nearly every big website or platform you go to. Every once in a while, you'll see a banner ad that's taking up the whole, or ads that are taking up the whole page from one advertiser, no matter how many times you visit that site that day. So they're trying to reach those target consumers and actually provide a better return on investment for advertisers and marketers. So the company allows its clients to utilize its cloud-based platforms to create, manage, and optimize data-driven digital ad campaigns across an array of channels, apps, websites, mobile devices, connected TVs, audio, really anywhere one might come across a digital ad in some form or another. So just think about how many people continue to pay monthly subscription fees for ad-free content. This is across Netflix, Disney Plus, Amazon Prime, Spotify's premium users, Apple Music, and countless other platforms. So this has heightened the need for tech-focused, data-driven solutions to reach specific targets and provide real tangible results. And the Trade Desk has grown its ability to provide results to clients with its robust, pretty much big, robust demand-side ad platform. So it's a massive space, this broader digital platforms across the array of things we've just talked about. And advertisers really want to know that they're at least reaching some of their targeted consumers and not just paying money and having really no way to know that they're reaching their intended audience. So with that out of the way, Wall Street has certainly noticed what the Trade Desk is doing. The company, obviously, though, was impacted by the coronavirus-based pullback as the entire global ad spending took a dent, especially in the second quarter. But the company has certainly bounced back. It bounced back in Q3, with the company topping our quarterly estimates at the start of November. Its sales were up 32% in the quarter, and it posted record quarterly revenue growth, a record quarterly revenue of over $215 million. We should also note that Wall Street has rewarded the stock over the last year, despite, as we mentioned, that setback in the second quarter, as the company was sure to come back as the broader economy started to rebound and people started to advertise once again. So the stock has soared after its Q3 release. It's now about 80% in the past 3 months, and this is part of a 280% climb in the past year. And if we look back even further, the company's gone on a massive run since its IPO in the fall of 2016, when it was trading at around $30 per share. As of Monday morning, the stock sat at $863 per share. And in fact, it hit brand new highs Monday morning as well, before dipping after that. So if we look ahead, Zach's estimates call for the Trade Desk's Q4 sales to jump 35% to help lift its adjusted earnings by 27%. If we look more broadly, the company's fiscal year sales are projected to climb about 22% to come in at over $800 million. And this comes despite the fact that its Q2 sales fell 13%, as we mentioned, with the big coronavirus-based hit. Meanwhile, its adjusted full-year earnings are expected to climb over 27% to $4.70 per share. The company is then expected to follow up its growth this year with another 34% sales growth in 2021 to hit $1.1 billion, while its earnings per share is projected to climb another 7%. So some big growth is expected this year and next year. And as we mentioned, its overall fiscal 2020 earnings are projected to climb in a big way as well. So the Trade Desk's impressive bottom line revisions help it land a Zacks rank #1 strong buy right now. The stock also earns B grades for growth and momentum in our style score system. In the end, investors really might want to consider buying the trade desk as a play on a world where marketers and advertisers must do really all they can to find consumers in our expansive digital age that's really just getting started. So just when you think about maybe your own life, it's definitely pretty much no matter what changed in some way of how you consume media in the last several years, as you might have reduced your cable package or gotten a Spotify account or paid for a Netflix account for someone or jumped into Disney Plus. So that's just the basic premise, is that advertisers aren't just going to stop advertising because you're not watching your 7 o'clock prime time television where you see ads every 5 minutes or so. So they're just going to have to find you in a different place. And the trade desk is certainly there to help those marketers and advertisers. And now we're going to transition to a completely different company as we take a look at the high-end cooler company Yeti, which trades under the ticker YETI. The company topped our third quarter earnings and revenue estimates on November 5th as it continues its impressive run. So the Upstart brand has expanded its portfolio, and we're going to sort of lay out why it could be poised for a Lululemon style run of success. Yeti was founded back in 2006, and the company went public in the fall of 2018. The Austin, Texas-based company has, over the years, bolstered its portfolio of heavy-duty, high-end coolers, which can cost up to $1,300, and expanded its consumer base pretty far beyond commercial fishermen and the like. So as it started, it became something you'd see on a chartered fishing vessel where you're getting some big sporting fish and maybe you need somewhere to put it in a big, giant $1,300 cooler so you don't waste your catch. And now as we've said, they're expanding their coolers to an array of colors, shapes, sizes. They've become staples at tailgates, cookouts, campfires, backyards, more than that. And Wall Street has also been really pleased to see that the company now makes a majority of its money outside of its more niche cooler market. The company's portfolio includes drinkware, tumblers, mugs, chairs, backpacks, dog bowls, hats, you name it. So the company's third quarter revenue jumped 29% to nearly $300 million. This marked its strongest top-line growth as a public company. More specifically, the drinkware space climbed 31% to account for around 60% of total sales, with its cooler sales up about 27%. We should also note that its direct-to-consumer business was up 62% last quarter, and the company has said it continues to benefit from the social distancing world as people try to spend more time outside. Plus, Yeti's larger ticket items might also be receiving a slight boom or boost from the booming housing market as people look for more space amid this coronavirus. And the market is finally being driven by millennials, so it could continue even past the pandemic. Let's also remember that many of Yeti's target customers, more of the affluent people around the United States and elsewhere, are spending less money on travel, so maybe they have more disposable income to spend on things to spark, spice up their house or their backyard, or as we mentioned, put it in the back of your truck when you go on a vacation or whatever you're doing as you try to navigate this social distancing push of a world. And now we're going to move on to kind of its branding power and how it might be thought of in a similar breath to Lululemon, which helped redefine a market while taking on legacy players like Nike and giving rise to imitations that can be found at places like Target. So Yeti's done a very similar thing. You'll see now knockoff brands that are trying to mimic what Yeti has been able to do with its cooler that's certainly turned into an iconic brand on a smaller scale than Lululemon and Nike, obviously. Both companies are certainly new age, higher-end brands. They've built loyal followings with a minimal advertising budget, so they've grown through social media, word of mouth, where people can now shop directly on places like Instagram. Yeti and Lululemon have both also become recognizable brand logos, and therefore there's like clear crossover in their target consumers. Peloton might also be considered part of this group of successful brands that stand out in crowded markets and are targeting a relatively similar audience. Yeti and Lululemon are also both expanding their standalone brick and mortar footprints. Obviously, Yeti is much smaller at the moment, but the company is trying to grow beyond its flagship store in Austin. The company currently has locations in Denver, Charleston, Chicago, and a few other strategic locations. Yeti coolers and everything else can also be found at places like Dick's Sporting Goods, REI, and other retailers that fit in with its brand image. And then in terms of price performance, Yeti has actually crushed Lululemon over the past 2 years. The stock is up about 270% versus Lululemon's 160%. And this outperformance is even more striking over the last 6 months, with Yeti up over 90% and Lululemon up about 20%. With that said, Yeti slipped Monday after hitting brand new records of just over $64 per share this past Friday. And despite its outperformance, Yeti actually trades at a discount compared to Lululemon. So Yeti is trading at 32 times forward 12-month earnings compared to Lululemon's 60 times. It's even trading at a discount compared to Nike, which is much older than Yeti. Nike's trading at 41 times, with Yeti trading at 32 times forward earnings. And this actually also marks a big discount to its own one-year highs of 44 times. And it's not too far off its median, despite the fact that the stock hit brand new highs just this past Friday. So if we look ahead, Yeti also continues to improve its margins through a larger direct consumer push, product cost improvements, and more. So looking ahead, the company's estimates, or our Zacks estimates, are calling for Yeti's fourth quarter revenue to jump over 16%, with its 2020 sales projected to surge 16% as well to about $1.1 billion, with its 2021 sales projected to come in another 13% higher. This would mark strong growth and the continuation of impressive top-line growth as it comes on top of 2019's 17% revenue growth. So they did 17% growth last year. They're supposed to do 16% growth this year and another 13% growth in 2021. And at the bottom end of the income statement, Yeti's adjusted FY20 earnings are projected to climb about 45% to $1.74 per share, with 2021 expected to come in another 18% higher. We should also note that the company has crushed our earnings estimates by an average of 72% over the trailing 4 quarters, so some impressive bottom line beats. And its positive post-release earnings revisions help it capture a Zacks rank #1 strong buy right now. Yeti also sports an A grade for growth in our style score system. And its leisure and recreational products space sits in the top 13% of our over 250 Zacks industries. So for all the reasons we've mentioned already, Yeti certainly looks like a stock to be considering as we head into the holiday shopping period and beyond. And now we're going to close out with a third company on our list, and that is the Boston Beer Company, which trades under the ticker SAM, S-A-M. The Boston Beer Company was one of the founding fathers of the craft beer revolution in the United States, and today its portfolio includes Samuel Adams, its flagship brand, as well as Dogfish Head and some other craft brands. But the stock has soared because of its push into the booming hard seltzer market that actually helped popularize. So its shares are up about 140% over the last year. This compares to its industry's 6% decline and the S&P 500's roughly 17% growth. So a really big run for SAM over the last 12 months. And this is part of an even bigger run over the last 3 years that's seen the stock climb over 380%. And a lot of this growth can be traced back to the launch of Truly Hard Seltzer in 2016. The company is Truly is one of 2 dominant players in the category, alongside White Claw, which is owned by a company that is not publicly traded. So the success of Truly and hard seltzer as a category has forced all the giants such as Anheuser-Busch, InBev, Molson Coors, and others to dive in with offerings under their flagship brands such as Bud Light and others. Corona Seltzer, Coors Seltzer, you name it, everyone now has a seltzer brand. Even Coca-Cola is trying to enter the market, and it's going to roll out one of its first alcoholic beverages under its Topo Chico seltzer brand for the first time in years and years and years. I believe that was back to the 80s the last time Coke a Coke product rolled out with alcohol. So that shows just how hot this market is. With that in mind, the global hard seltzer market could reach about $15 billion by 2027, expanding at a compound annual growth rate of over 16%. And we should note that Boston Beer's founder has called the hard seltzer market the biggest thing since light beer. So that's sort of the comparable thing for this hard seltzer market. It's a brand new market, and it is growing like wildfire so far. So if we look back, Truly, we can see Truly's impact. Sam's revenue jumped by 15% in 2018, 26% in 2019, and that's after it slipped slightly in 2017 and 2016. So we should also note that the company's sales have surged by at least 30% in the first 3 quarters of 2020. And if we look ahead, its growth is even more impressive. So Zacks estimates call for its sales to skyrocket 50% in Q4 and another 50% in the first quarter of next year. So overall, its 2020 revenue is projected to climb about 40% this year to $1.7 billion, and then jump another 32% in 2021 to about $2.3 billion. So some really impressive top line growth is expected to continue for the Boston Beer Company. And we should note that both of these growth estimates would mark the company's strongest growth as a public company. Meanwhile, its adjusted earnings are projected to soar about 63% this year and another 56% next year. So really big bottom line growth is expected as well. Boston Beer's impressive earnings revisions help it land a Zacks rank #1 strong buy right now, alongside its A grade for growth in our style score system. And overall, despite this strong run, Sam's stock rests about 20% below its late October highs at around $900 a share. And this is as of around noon trading on Monday. And it recently fell below its 50-day moving average, which could set up a better buying opportunity for those who are high on the stock, as it hasn't liked to stay below that 50-day moving average in its recent trading. So that said, the company also trades at a solid discount against its industry in terms of forward sales. It's trading at about 4.9 times, so about 5 times forward 12-month sales, against its industry's 16 times forward sales. And this is despite crushing that beverage market. And it also comes in not too far above the S&P 500's average, despite its insane run over the last several years. Therefore, some investors might want to consider buying Boston Beer stock, even though it's already been on such an impressive run, especially when we consider that the hard seltzer revolution is really just getting started, and Boston Beer's company's growth is expected to really start to kick into gear this year and next. And we should also note that it sits in an industry that's rests in the top 20% of our over 250 Zacks industries. And amid all of this social distancing and coronavirus-based economy, it seems that booze sales are still doing really great, and it appears that Truly is helping Boston Beer Company stand out amid this really, really crowded space. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.